Hello everyone, Corey Mitchell here with TradeThatSwing.com, and in this video we're going to look at the S&P 500 PE ratio. Happened to look at this today, and yeah, it's at one of the highest levels it's been before price decline. And you can see there's been a few times on this chart where it has gotten higher than the current level. But interestingly, those higher levels have occurred after prices have already started to decline. So prices had started declining, but earnings decreased faster than the price. So company earnings decreased faster, which resulted in a spike in the PE ratio. So when this huge spike occurred in 2009, stock prices have already been declining for a year, and we're actually already starting to recover when the highest PE ratio hit. Stocks actually started declining right around here when PE was just above 20. We had the major 1999-2000 crash, and prices started declining. I think it was right around, we'll look at the actual numbers, but it was right around in here. When COVID hit, the PE was right around kind of where we are now, or just a little bit below where we are now, kind of like 20, that was early 2020, so it was right around 25. You can see the top numbers show up along here. So yeah, in early 2020, where is that one? Right there. Yeah, around 25. Prices had a sharp drop, but the PE spiked after that. So barring those kind of situations, we are at the highest level we have been. That includes going back to the 1930s. So a very high valuation on stocks. If you look at it from an inflation adjusted point of view, this is the Shiller PE. Again, very high. Kind of the only time we were above this was the 2020 .com, and we also recently 2022 got a little bit higher. Then we had this pullback, and now we're climbing right back up. So yeah, one of the highest historical valuations. So we had talked about earnings and how that affects it. So you can see we've been moving up on earnings. This is company earnings, and yeah, moving up, but you can see these big drops. This was the really big one that caused that PE to really spike back in 2009. We got to go back to this one. Caused that PE to really spike because earnings dropped so much. So this doesn't, I bring this up just to point it out. It does not necessarily mean that stock prices will crash. It could mean that, but you would want to watch the actual price action in the S&P 500 to determine that. Right now we are going up, and so you can use your own methods to determine when this is a time to get out, but we are very overvalued by historical terms. So if you're conservative, maybe you back off on buying for until valuations are a little bit more reasonable. The downside of that, of course, is that maybe PE stays higher and stock prices continue to go up and earnings continue to increase. So PE can go down in a number of ways. You could have prices drop and earnings stay somewhat similar, or maybe drop a little bit. But if prices decrease at a faster rate than earnings, then PE is going to decrease. If you have earnings that continue to increase, but prices stay somewhat stable, maybe they only go up a little bit, they drop a little bit, or they stay pretty flat, but earnings are increasing, that will also decrease the PE ratio. If you have declining earnings, you are generally going to see stock prices fall first but that situation will spike the PE because now earnings are much lower relative to the prices. So if you have fast declining earnings, that will tend to spike the PE and increase it. And we generally see those later in the cycle. So prices will have already declined. You see a really big spike in PE, and that's usually once prices have already started to recover. So just a little bit about this. I assume you're going to start to maybe hear a little bit more about PE just because it's getting to an elevated level. Whether you look at inflation adjusted, whether you look at the normal, or even if you're not looking at the S&P 500, this is one that looks at it looks at the stocks that are in the VTI ETF, which includes about 3,700 US stocks. It's called the Total Market ETF. And kind of a broad measure of the overall US stock market. And you can see we are at one of the highest levels that we have been in the last 30 years or so. So just something to be aware of. We're kind of near that level of, the 2000 peak. According to this, in 2008 and so, we weren't too bad off, but we still had a big crash. And so PE, not by any means a perfect indicator of whether prices will rise or fall, but it is noteworthy how high it is, and maybe consider that, maybe do some research into how you want to manage your funds during such periods, and just something to be aware of. To finish off, let's quickly look at what stock prices were doing as these PE ratios were really spiking. So let's look at each one of these really big spikes, which were higher than the currently highest reading we've seen. If you scan across, there's no reading that's higher than 28 historically, other than this spike, this spike, this spike, and this spike. So let's quickly look at these spikes. This last one occurred March 2099. Let's look at what was going on around then. So that was right around here. Prices were still going up. This was the dot-com bubble. And then we start to see prices eventually roll over. Let's call it around October or just late 2000. So let's see what was going on then. So come late 2000, stock prices are rolling over, and this is where your PE was, right around 27. So slightly lower than we are now is when stock prices started to roll over in the 2000 dot-com bubble. But remember, they were a little bit higher before mid-1999. Prices continued to go up, but didn't eventually fall till a little while later. So the ultimate decline started in around here, late 2000. PE did not spike and reach its highest point till December 2001. 2001. So late December, or late in 2001, that's right around here. So prices had already been declining for more than a year when the PE finally spiked, because it takes time for the earnings to be released. Investors are already maybe anticipating that earnings have been a little bit too high. They've been maybe hyped up as what happened in the dot-com bubble. And so then earnings actually sank, and they sank more than what prices had declined, right? Because if you have a 30% drop in price, but you have a 50 or 75% drop in earnings, that's going to increase the PE. So that's what happened, and then we ultimately continued to decline. Let's see what happened here. This was March 2009, basically, when it hit its peak at around 120. You can see that number right at the top near that spike. So let's go to March of 2009. That is as prices are already starting to recover. So the PE really spiked after basically the selling was all over. because again, it takes time for those earnings to be swept through to come to fruition in the actual earnings announcements. So the actual decline started, let's call it right around here, this late 2007 to early 2008. Let's see what was happening right around then. So late 2007, early 2008, you're at around a PE right in that range of about 23, 24. So that was right there. Then prices started to decline. Then you get the spike later on in PE, but prices have been already falling and continue to fall. Let's look at this spike here, September 2020. That's the pandemic. Ignore these other lines that say out invested. That was for some other research I was doing. So that's here. That was the pandemic. So the spike occurred again September 2020, peaked at 35. September 2020. Let's find September 2020 here. That's here. So the big drop in prices had already occurred. Prices had already completely recovered from that decline, but PE spiked way late. So what was the PE when the actual price started to decline? That was in early 2020, right around February. So let's look at what it was in February of 2020, right around there. Let's see if we can get March 2020. We were right around 25. So it was already a pretty high PE when COVID hit. So prices started to decline right around here, February, March 2020. Prices decline. PE does not peak till way later because it takes time for earnings. And you can think about this is a good example because it shows how PE works. So prices fell pretty dramatically, pretty swiftly, 20-30%. So S&P fell 30%. A lot of stocks might have fallen more, some less. But you can think about a lot of companies that had their earnings basically go to zero or negative because they couldn't do any business during COVID. They were basically shut down. So if you think about PE from that perspective, even if their stock price dropped 50%, but their earnings fell into negative territory, now they basically have an infinite PE. So that's how the PE can spike because that's going to happen. Even with S&P 500 stocks, a lot of these really big companies had negative earnings or saw a dramatic decrease in their earnings. So if the stock price fell 20% but earnings fell 50%, you're going to get a spike in PE. So that's how that happens. So we see high PEs preceding declines, but we see the highest levels of PE generally much later after the decline happens. So that's kind of the takeaway and to understand how this happens. Sometimes when we look at a chart like this, just look at the PE chart, we assume that, and we're just kind of estimating like, oh, this highest value occurred and then stocks declined. That's not the case. We generally have a reading of kind of where we are now. And again, I'm not saying we're going to get a crash. I have no idea. I'm just pointing out information, and it's up to you to decide what you want to do with it. But we are at a typically high level, and yeah, something's got to give. Either earnings have to increase and prices have to, kind of stabilize, maybe just go up a tiny bit, stay flat, or go down a little bit. Otherwise, yeah, because likely we're going to head back into lower PEs at some point, and prices decline to do that. So, yeah, something to consider. And yeah, that's just a quick look at how this has actually played out in recent history.